Hey, it's Patrick Moore here with Ironclad Wealth Management. And today we've got part two in our guide on how to minimize your taxes on the sale of a business. And today we're going to talk about structuring. Specifically, what's the difference between an asset sale and a stock sale? Because kind of understanding this will inform you as to how much you're going to pay in taxes, as well as which strategies may be available to you to actually help you then reduce those taxes. So, first things first, as always, this is general information. This is not specific advice tailored to your business. That needs to be reviewed with your own tax team. But this is something that hopefully you will learn from to improve your knowledge as you think about and contemplate selling your business. So, why does it matter? Well, it matters because your structure impacts your taxes, bottom line. And generally, as you can imagine, when you're selling a business, you're on the opposite end of the aisle from the buyer. You are really not in a position to take advice from them. And generally, buyers prefer an asset sale and sellers prefer a stock sale. So, depending on the give and take of a negotiation, depending on where you land, it may actually influence the sales price and several other factors in the deal. And depending on which industry you're in, it may actually impact you as far as which one might be right for you. So I say generally because sometimes maybe an asset sale will be better for the seller too. So, what are the basics? In an asset sale, the buyer purchases the assets. If you think about it, let's say you're doing like toy manufacturing. Well, you got your company, and then inside the company, you got a factory, you got your supplies, you got your equipment, all those good things. And in an asset sale, the buyer isn't buying the company, they're buying those assets from the company and then putting them in their own company. In that scenario, you actually hold on to your old LLC, C Corp, whatever you used, and then the buyer gets a fresh start and full depreciation benefits on the tax side. As well as, and this is probably the most important part for most buyers, they don't assume the old liabilities that you incurred when you were running the company because they're in that new corporate shell. Now, there's always some exceptions, but that's the general rule. Now, a stock sale is different because the buyer is buying your whole company. They are just paying you for the stock of that company. And because of that, they're assuming the liabilities. And for you, a seller, it's much simpler. And you receive capital gains tax treatment on the sale. Whereas in the asset sale, you could have a mixture of taxes in there, which we'll get into in a little bit more detail. So for the seller, if you have an asset sale, like I said, that you're actually selling your property, you're selling your equipment, you're selling your supplies, and all of those can have different tax treatment. Some of them can have ordinary income. Some of them can have depreciation recapture. Like if you've written things off in the past, well, that means you don't have any basis in it and you got to pay taxes on the full amount. And what happens is that's all kind of agreed upon in the sale. It's agreed, okay, how much is each of those things worth? That's how much the sales price is associated with each asset, which then informs what your taxes are. Now, kind of goodwill, things that's kind of value not associated with an asset, you do get capital gains for that in an asset sale, but it's typically, not always, not going to be the full amount of the transaction, which means that you might wind up paying more than the capital gains rate. Because in a stock sale, what you do is you get capital gains treatment on the stock of your business based on how long you've owned the business. You may also get QSBS, which we discussed briefly in part one of this, and we've got a more in-depth video coming out later. But typically what it means is because the top ordinary income bracket is 37% and the top capital gains bracket is 20%, it means that typically people like to save that 17% and a stock sale is preferred by a seller. However, things can get complicated because that's at the federal level. And at the state level, things can be a little bit different because capital gains and ordinary income in most states, I would say, are similar. It's the same rate, just kind of applied to both categories, but there are exceptions. For example, let's say you're in Georgia. Well, you're probably going to prefer a stock sale because it doesn't make a difference, and so you save that money on the federal side. But if you lived in Washington state, they actually have no ordinary income tax and a 7% tax on capital gains over and above a certain threshold. So, interestingly enough, depending on the parameters of the sale, it may be worth a little bit less fight trying to say, okay, hey, I need to get that stock sale. I need to get that stock sale. Well, if the difference is only 2 or 3% instead of 17, maybe you can afford to give a little bit of that and maybe get some more back on the purchase price. So this really what it does is it informs your negotiation, it informs your planning, it puts you in a position of power to know this information. Now, I do want to go over the buyer side real quick if anybody watching this video is considering buying a business. If you do an asset sale, you can get depreciation on the fixed assets. In the example where you're buying a factory, you're buying equipment, it's like you've bought them new. So if it's something that has a 5 year life, well, you can depreciate it over 5 years or use bonus depreciation if it's eligible. It basically gives you some extra oomph in those early years for tax deductions, which means you might wind up paying less in taxes and have higher cash flow in those early years where you may be kind of hurting for cash flow trying to figure out the business and stuff like that. So, not every asset's going to qualify, but typically you get those depreciable benefits when you do an asset sale. Whereas in a stock sale, you have to amortize your purchase price over 15 years. And so that 15-year purchase or amortization schedule, I mean, compared to depreciating a lot of stuff in year one, it really stretches those benefits. And so an asset sale is just worth a lot more to you as a buyer. Now, there are ways to do a stock sale and have it treated as an asset sale. It's called the Section 338H10 election. You need a tax attorney to look at that one for you. But what happens there is for the seller, it's actually from a tax perspective treated as an asset sale. The buyer gets to take that depreciation, and then you're still just buying the stock of the company. So it's kind of a middle ground where both parties can benefit from it. But because there are negative tax aspects for the seller, there may need to be some adjustments to the purchase price to get that done. So, which one is better? As with everything when you're dealing with finance, it depends. So it depends on your industry, it depends on your state, it depends on everything. But I've got two examples just to show you how differently this can operate. And the first is a service business, and the second is a manufacturing firm. So let's look at the service-based business. This is selling for $10 million. And if we look at this, I just said, okay, no basis. And so in the third column, I have the asset sale. And what assets are there? Well, it's a service-based business. All they have is like some office equipment. It's all been depreciated. It's Section 1245 equipment, which means it's going to be or property, which means it's going to be recaptured at ordinary income rates. So it's $100,000 at ordinary income rates. And then the remainder of that is goodwill, which is $9.9 million. And that's all taxed at capital gains, even if it's an asset sale. So that results in $2.017 million in taxes. Now, if we go to the stock sale, they're just buying $10 million of stock. That difference is only 17% of $100,000, which is another $17,000. So obviously in a vacuum, you prefer to keep $17,000. But when you're looking at it under these facts, these circumstances, and this is probably something where there's very rarely something that's this clean, but it's my video, I get to make the example. When you look at this, why would you sit there and fight in a transaction about what you need to do and how you need to do this, right? It could be a situation where you can afford to say, okay, hey, what do you need to do? And then you can kind of, fight over other deal parameters. But without knowing this, you're not going to know what you need to do. Now let's contrast this with the manufacturing business. They've got inventory. They've got accounts receivable. They've got equipment and real estate. They've got goodwill. They've got stock. If you look at this, all of that equipment, all of that accounts receivable, all of that inventory is subject to depreciation recapture and ordinary income. Now, what I did is I took each of these and I just applied a 37% ordinary tax rate to these and then 20% capital gains. But whereas if it was a stock sale, the seller would have only paid $2 million in taxes. In an asset sale, they would have paid $3.19 million. So as you look at this, there is a major, major difference in how they're going to be taxed. And I think you could reasonably assume, okay, that could have a material impact on what that seller is planning to do for the rest of their life. That's $1 million less that they would have, whether it's more, whether it's less. That's something you need to be prepared for. And so if somebody is going to insist on an asset sale, well, hey, maybe you need to negotiate for a higher sales price. Maybe you need to see what you can do to push it towards a stock sale. But depending on what your business is, what state you're in, this is something that's going to have a major, major impact on this. But remember, let's say you're in the state of Washington. Well, state of Washington, what would happen is those capital gains would be subject to taxes and the ordinary income wasn't. So there are a lot of things to consider here, but just understanding this and understanding how your business will be taxed is key to your long-term planning. Now, the only way to really know this is to look at your balance sheet and then talk to your CPA or whoever does your accounting for you to kind of drill down and say, okay, if I were to sell this business, how is this going? Let's do a projection of how this is going to be allocated to get a better idea of what's going on. So, just to summarize everything, and you know this, if somebody comes to you to buy your business, they are directly at odds with you. They're not trying to help you, they're trying to get the best price, and they don't care about your taxes. You care about your taxes, it's not their responsibility to know about them. You need to set up the deal in such a way that you're minimizing your taxes to put more money in your pocket. So start planning early before you start negotiating. Sit down with your accountant and don't skimp on a couple of hours of work with them to say, okay, what would I owe in an asset versus stock sale? That impact can be significant depending on the type of business that you have. Structure that negotiation with taxes in mind, but as I said a few times earlier, remember the deal should be evaluated in its totality. Use those taxes as a negotiating lever and don't just focus on them to the detriment of other kind of areas of the negotiation, because I'd rather make more money and then pay more taxes if I wind up in a net better place. And remember to collaborate with your financial team. So in the spirit of collaboration, we have a lot of other videos on strategies to save money on taxes of the sale of a business. Schedule a consultation with us if you'd like, and it's a lot better to do that, especially before you have an LOI signed, because there's more strategies available to you. And really the best case is over a year before you're looking at a sale, but that's not always realistic. So if you want to schedule a call with us, great. If some of this information you can take to your existing advisors and accountants, please do. But get started earlier, you'll wind up in a happier place. So I hope you have a good rest of the day. Talk to you later.